the S&P and the Fed. This one chart I keep coming back to. It doesn't show price, it doesn't show earnings. It shows the stock market divided by the size of the money printer, the Federal Reserve's balance sheet. And here's why your ears should perk up today. Back when this chart was first passed around, that line was sitting near the floor, down around 0.0007. A market that looked cheap next to an ocean of Fed money. Today, the same line has climbed all the way to 0.011, which happens to be the long-term average, the exact middle of its entire history since the 1990s. That's not a small move. And in 9 days, the Fed sits down again. So the question isn't, did I miss it? The question is from the middle of the road. Which way does this thing breaks next? And how do the prepared proposition are you in? How are you going to prepare for it? That is the whole show. And welcome back to the Black Swan channel. I'm glad you're here because this is a kind of chart that separates people who react to headlines and people who read the plumbing underneath them. And here's the promise that I make to you. First, I'll show you the news, where the market and the Fed actually stand as of Friday's close. Then I'll teach you to read this one ratio so you'll never unsee it again. Then, and this is the meat, we'll walk through the path and see what happens. Plain English the whole way. And don't forget, if you want these breakdown, the second they drop, hit subscribe and hit the bell. Keep telling that to everyone that listens because it is important. And if you want to dive deeper in some of the options that I have as for my investors and my members, I do live daily stock market commentaries. I showed you my trade details. I do live weekend analysis. I also do investment cheat sheets. I do regime change update. I do chart of the day, prediction market analysis, Black Swan Lake deep dives. Where are they? No past trades and more regime change updates. And of course, the Black Swan interview. So, where are we now? Number one, the S&P closed Friday, 74.57. When the chart we're studying was captured, the S&P was around 5,000. We are now roughly 47% higher than that snapshot, about 18% higher than we were a year ago. That's a powerful, broad climb. Number two, the Fed balance sheet sits near $6.7 trillion. That is a total pile of assets the Federal Reserve is holding. For years, that pile was shrinking. The Fed was quietly pulling money out of the system. That mattered enormously, and we'll get to see why. Three, interest rates are parked around 3.5 to 3.75. That's the Fed fund rate. The Fed held steady as its June meeting, and its next decision lands July 28th and 29, 9 days out. Markets puts the out of another hold at roughly 87%. Now, here's the wrinkle, and this is a part most people miss. The Fed has quietly stopped shrinking its balance sheet. Since the start of the year, it actually began adding again, buying short-term treasury bills, nudging that pile up by around $150 billion. The tide that was going out softly is returning. There's a catch to the mood enough, right? Honestly, as I say, this is the Fed is leaning hawkish. That's the word for worried about inflation and reluctant to cut. Roughly half the committee has flagged they could even raise rates before year end, before inflation has been sticky, partly on tariffs. And just Friday, the market got a jab. Chip stocks sold off on fears that the big AI spenders might dial back and the S&P slip about 1%. So let me translate that Friday wobble because it's a preview of the whole debate. A huge chunk of this year's gain has come from a handful of AI and chip names. The market has been betting that the biggest tech companies keep spending fortunes building out artificial intelligence, AI. So the moment a rumor floats that maybe they'll spend less, these stocks flinch first. Meanwhile, the fear gauge, the VIX, basically the market's heart rate monitor, ticked up but stayed calm, still down nearly in the high teens. That's not panic. That's a market that got poked, not punched. And that's the lesson to carry through this whole video. One nervous Friday is noise. The tide underneath is the signal. So that's the board. A market near record high, a Fed that just turned the money tide back on uneven while it walked through, and a fresh reminder this is rally can wobble. Hold all of this in your head if you can, because I want to show you the single chart that ties every one of those threads together. And as usual, what we're saying here is that we are telling you stories. I am telling you a story right now that I think a narrative that is driving the market. But be always wary of narratives. They could make you spend money and they could make you sell stocks, right? You never know exactly what is really driving the market. We're grabbing up news, we're grabbing up stories, and we're trying to correlate to what's happening with the market. And the market is a powerful thing because once it decides to sell, you're out. This is all about trying to understand what's happening. And you don't understand in one video. There's no one video that's going to tell you, well, this is what's going on. It doesn't work that way, right? You don't become a doctor in one day. You need to every day. And in fact, the most successful investor, Jim Simmons, said, I wasn't particularly smart, but I tinkle a lot. Every day I try to understand what the heck is going on. That's exactly what I do for you. So let's take a look at the chart itself. And let's try to understand what is going on, right? Look at the shape, because that tells the whole story of the past 25 years. That tall peak on the left is 0.0026 in March of 2000. That's a dot-com top. Then the Fed's balance sheet was tiny and stock prices had gone vertical. So this ratio blew out the highest reading on the chart. Don't forget what we're doing. This is the S&P divided by the Fed balance sheet. And the Fed balance sheet is tiny and the S&P is big and large. That's what the number shoots up. It was the market's way of saying prices had gotten very stretched relative to real money. Then follow it down to the deep valley, 0.0003 in November 8 of 2008. The financial crisis. Stocks collapsed, and at the same time, the Fed exploded its balance sheet to fight the fire. Big money pile, small stock market. The ratio hit rock bottom. The lowest point on the entire history. And here's a plain language takeaway I want you to keep in mind. High on this chart has meant stretch, low has meant flooded with Fed money. And the middle, which is 0.0011, is exactly where we are today. Not euphoric, not crisis cheap, dead center. So let me put that in a simple gauge so that it lands. It lands very well for you. Look, that is what you want to take a look at. So you want to see the math in the simplest possible term. Today, it's the S&P is at around 7460 divided by the Fed pile of $6.7 trillion. That gives you the ratio. Grind that out and you land at 0.0011. Now imagine stocks keep climbing, but the Fed pile stays flat. The top number will grow, and the bottom number stays put. So the ratio rises, and the market is standing more on its own 2 feet. Flip it. Imagine a crisis where the Fed floods in trillions of dollars. The bottom number balloons. The ratio sinks, and suddenly stock looks cheap next to all that money. That is the entire mechanism. Two numbers, one story. And I want to frame that positively because it's earned. We didn't get to the middle by the Fed pumping in a free ocean of money. We got there because the market grew into it. Earnings, job, prices, climbing while the Fed pile held roughly flat. That's the good kind of progress. That's a market walking on its own leg. Now, let me say that again. This was not given. These companies that are about to release earnings this week, making money. You may not think that they're making enough money, but these are real businesses. So do not let the pundit telling you that be careful, because obviously it sells headline. The market is going to crash. The market is going to crash. The market is going to crash. So you stay out, you wait for it to crash, and it never happens. Oh yeah, the market went, so the NASDAQ 100 dropped about, 8% over the past 3 weeks. And it was mostly because, frankly, South Korea dropped by 25%. Which I don't know why we are looking at South Korea to what's going on here, but it's just a story. It's another story. So let's take a look at history. Let's rewind to 2000. Small Fed, high-tech stock. The ratio is at around 0.0026. Then the dot-com burst and the 2008 crisis dragged it all the way down to 0.003. For the next decade, the Fed kept its money pile huge, so the ratio stayed low. But notice it was quite grinding higher the whole 2010 as stocks steadily recovered. Then 2020, the pandemic, the Fed did the biggest money flood in its history. The balance sheet rocketed from around 4 trillion to 9 trillion in barely 2 years. That giant denominator crossed the ratio right back down. It looked for a moment like 2008 all over again. But watch what happened next, because this is the encouraging part. From that low, the line has climbed relentlessly through 0.007 in 2024. The market didn't need the Fed to keep flooding. It clawed its way back to the middle on the strength of real earning and resilient economy. Here's the pattern that history keeps whispering. This ratio spent most of its life traveling between the flood and the froth. When it's been near the bottom, that has tended to be an opportunity. The step up before a long climb. When it's stretched near the top, that's when the air gets thin. Right now, we are neither. We're in the fat middle. Quick pause. This is clicking. Do me a favor. That is subscribing, and that is becoming a member. So let's make the Fed money pile idea concrete, because it's the engine under this whole chart. When the Fed wants to help the economy, it creates money and buy bonds. That's called QE, quantitative easing. Think of it as the Fed flooding the pool. More money slushing around tends to lift the boats, including stocks. When the Fed wants to cool things off, it does the reverse. It lets bond roll off and drains money out. That's QT, quantitative tightening. The latter, the water out of the pool, is what the Fed does. Why does this matter for your money? Because the money is tied to the denominator of our chart. When the Fed floods the pool, the ratio gets crushed down, and historically stocks have had tailwind. When the Fed stops draining and starts adding again, that headwind for the last couple of years quietly becomes a tailwind. That's exactly the pivot we're living through right now. There's the other level too, the price of money, interest rate, as you could see. Here's where we've been and where the money thinks we're heading. So the dark line that you're seeing, right, is the actual interest rate. You can see it rocket from near zero in 2022 at about 5.5%. Then it eases down towards 3.5 to 3.75. The gold dashed line, it was future traders are betting comes next, a gentle drift back towards 4%. Translation, the market isn't counting on rate cuts to rescue stocks, which means the balance sheet ride turning back on matters even worse, it's even more. So here's the honest balanced picture here. Rates are staying firm, maybe even hedging up. That's a cautious flag. But the money tide has turned back in. Two levers pulling in opposite direction. So the market has climbed all the way back to the balanced middle, which is 0.0011, and it did it the healthy way by growing, not by being flooded. The Fed's money tide has quietly turned back in, and from this middle ground, the odds lean constructive, while the downside rows look more like discounts than disasters. I mean, the urgency is real. On July 29th, 9 days out, and it's a fork on the road, right? The uncertainty is real too. Two Fed levels pulling opposite way, but you now understand the machine well enough to read it as it moves. And that's the entire game, not predicting the future. I mean, what we're really doing is we were saying that, listen, I mean, this economy is fine. Maybe we're paying too much for things, okay, but there's money in the system. It's flooding the system. Why do you think this is happening? Because the Fed has learned historically that whenever you tighten the money supply, you get into trouble. In fact, Milton Friedman, the greatest economist in the world, basically said that, listen, guys, you know what the Fed should only do one thing, and one thing alone, is either you open the spigot to let the money go in to flood the system, or you should remove the spigot to cool everything down. That's what the Fed should be doing at the end of the day. Obviously, you want to do it at the appropriate time, but you don't want to reduce the liquidity, because that gives you 1929.